Well, good afternoon. Happy Friday, February the 4th. Mark Milam here, your mortgage professional with Highland Mortgage, coming to you with this week's interest rate summary and market update. So how are mortgage rates doing this week? Well, I've got one word for you. I'm not sure how to spell it, but it sounds like yuck. That is exactly how mortgage rates are doing. It has not been a great start to the year for mortgage interest rates. Unless you've been under a rock, you've certainly heard that inflation is running over 300% of the Fed's target. We're not only talking about price, but wage inflation, and more news today to show that the economy is in overdrive. Jobs are heating up. The non-farm payrolls number, which was forecast to come in right around 150,000 jobs created in the last 30 days, came in at a scorching over 400,000 jobs created in the last 30 days. And they went back and revised December's number up from 190 to 510,000. This double whammy from December to January now getting reported here on February the 4th really caused some havoc for mortgage-backed securities. When we think about it, mortgages are just long-term bonds, and bonds hate inflation because it erodes their value over time. And so we've got inflation now over 7%. We're adding all of these jobs. We know what that means. When we're adding all these jobs, it just means people have more money to spend. We already have too many dollars chasing too few products. That's what causes inflation, and that trend is going to continue. So now what we're talking about is the Fed rate hike, which we all know is coming in March. Probably going to be upwards of a half a point versus a quarter of a point. It is certainly baked in that the Fed is going to hike the Fed funds rate in March. It's just a matter of how much. Let me show you a couple of headlines here since that report came out this morning. We were actually warned by the White House in January that the non-farm payroll number could miss because as many as 9 million people called in sick during the survey period, primarily due to the Omicron virus. And the ADP employment report, which is a precursor, sort of a preview to the jobs report, came out on Wednesday of this week, and it was a huge miss. The ADP report showed that private employment subtracted about 300,000 jobs over the last 30 days, but that did not hold true for the non-farm report. Sometimes the ADP and the actual non-farm payroll report from the government can be quite different. Our non-farms came in at 467 versus an expectation of 150. And then this double whammy that the December print was revised from adding 199,000 jobs to 510,000 jobs. That means in the past 2 months, we've added 778,000 jobs. It's causing hourly earnings to go up. The employment rate hovering right around 4%, right there near maximum employment. So here's what that's doing for mortgage interest rates. We are losing a little bit more ground. We're up about another 1/8 of a point overall across all products from this time last week to this time this week. This time last week, we were up 1/8 of a point from the week prior. And so we're seeing this slow progression up for mortgage interest rates. You can see this was today. We could see mortgage-backed securities selling off. This was yesterday. Really only one day this week where we held serve, which was Wednesday. That's when that ADP report came out. Now listen, it's still the cheapest money you can find. It's still tax-deductible money. It's not like we're seeing interest rates in the 6s or 7s or 8s. The interest rates across a lot of spectrums are still in the high 3s to potentially low 4s, but we are far cry from where we were with those historic lows all the way back in early 2021 and late 2020. If I can be of any service to you, please don't hesitate to reach out, mark.milam@highlandmtg.com. Have a good weekend.